Intermediate Accounting 6G, allocating sales proceeds to different types of securities. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email, and the website. The book Cost Accounting for Dummies is out in March of 2013. We're teaching a free online course. We teach a chapter every Saturday that you can find on the website and the Twitter account. So, recent videos in this Intermediate 6 series have talked about allocating investment securities, allocating sales proceeds to different types of securities. So, in this example, the concept is to allocate proceeds based on based on fair market value. So, if I get proceeds in the door, if I get cash, and I have to assign carrying values to the securities that were issued, I do that based on fair market value, which is something fairly common that we see throughout accounting. But this introduces a problem, which is, well, what if the fair market value of at least one of the securities isn't known? And the answer is that we use the amount received for both securities, in this case a bond and a stock, and we subtract the fair value of the security that's known, the known fair value. I put that in parentheses, and whatever is left over is assigned to the other security as a carrying amount, because again, the goal here is, what do I use to value the securities, in this case a bond and a stock, that are put on my books? There's another concept that I need to mention here, which is par value, and par value is simply an accounting entry for common stock. It doesn't have a lot of meaning beyond that. What's important, though, is that any proceeds received over the par value is considered additional paid-in capital. So if I issue 100 shares at $1, the par value would be $1 par times 100, or $100, and that's the value I would assign to common stock. It's the par value multiplied by the number of shares issued. So here's my example issuing two different types of securities. We issue 50 bonds. We're given in the question an interest rate of 5% and a 10-year maturity. That's not really needed for this problem. The face amount per bond is $1,000. You've seen that before. So that the total face amount issued is 50 bonds times 1,000, or $50,000. It turns out in this example that the fair market value of the bonds, not the face amount, the fair market value of the bonds is $45,000, which is less than the $50,000 face amount. That means that the current value of the bonds is a discount, something less than par. And so instead of the yield being 5%, the yield to maturity, which I talk about as total return, which would be the interest rate you get on the bond, 5%, plus a gain that you would get if somebody bought it at $45,000. Interest income plus what you earn as a result of paying a discount. That combination is called yield to maturity. The reason I go through that is oftentimes in questions it will say the bond is, quote, priced to yield 8.5%, which is another way of saying the yield to maturity is 8.5%, and I like to think of yield to maturity as total return. Yield to maturity, YTM, you can think of as the total return. That's important to write down. So we issue some bonds, but we also issue some stock. I define par value. In this example, we'll say it's $10 a share. We issue 5,000 shares, which means that the total par value is the $10 par value times 5,000 shares, or $50,000. This is the amount that is posted to the common stock account in the equity section of the balance sheet. Finally, we'll say that our proceeds received are $200,000, and now the question is, what carrying amount do I assign to the bond and to the stock? Well, I first take the total proceeds and I subtract total proceeds of $200,000 from the fair market value of the bonds that I was given, 45,000, and you can see how those are linked. And so I'm left with an amount allocated to stock of 155,000. So I subtracted the total proceeds, I subtracted fair market value of bonds from the total proceeds. Excuse me. So this should say subtract, if I could make a correction, the bond's fair market value from the total proceeds. I've got that written backwards, so let's correct that. So that's step one. Step two is I subtract the par value from the amount allocated to stock, 155,000, and that gets me additional paid-in capital, which is capital paid in over and above the common stock par value. So the amount allocated to the stock I just figured out in step one, 155,000. I subtract the total par value for the stock of 50,000, and I get additional paid-in capital of $105,000, the amount paid over the par value. So now I tie it together in a journal entry. We got cash of 200,000. That's a debit, cash in the door. We have a bond payable of $50,000, which means that at maturity we have to repay the face amount as an issuer of $50,000. So that is a credit because it's a liability account, but it's a payable account liability. That's for the face amount of the bonds. Here's the par value of the common stock, which we've talked about several times, $50,000. The additional paid-in capital is a credit. We figured that out in step two. So this credit is a liability bond payable. These credits for common stock and additional paid-in capital are credits to an equity account. Now, in order to make debits equal credits, I need a $5,000 debit. For example, if I made this 0, you can see that debits don't equal credits. So I need a $5,000 debit to make things balance. That is the discount on bond payable, and another way to figure that is I could create a formula by taking the face amount of the bonds I issued less the fair market value to get that $5,000 so that I can link those two numbers. So what I've done in this journal entry is record cash that I received, the liability for the bonds that I issued at face amount, the common stock and additional paid-in capital credit for the equity, and the debit for discount on bond payable. Now I can change the example just slightly. What if the fair market value of the bonds was $55,000? Well, now the bond's being issued at a premium. So it might be priced to yield something less than 5%. I'm going to say, just to make up a number, that it's 4%. I'm sorry, I'm going to make it $60,000 premium. Okay? The entry would look slightly different. Instead of a discount on bond payable, I'd have a premium on bond payable. So to make debits equal credits, I could make the credit equal to the fair market value less the face amount, which would be a credit of $10,000, and that credit would be a premium amortized over the life of the bond, just as the discount on bond payable was amortized over the life of the bond. It's a premium because I received in more dollars, cash, than the face amount of the bond, so in order to make it balance, I debit the cash I got for the bond, I credit the liability, and I also credit the premium on bond payable, which I would amortize into income. The discount would be amortized into expense, the premium would be amortized into income. You can look at my intermediate accounting, I believe it's 21 and 22 videos, where I talk about the effective interest rate method for a premium and a discount bond, which will help you understand both premiums and discounts. That's the end of Intermediate Accounting 6G. We have video textbooks listed on a page on the website. All the YouTube videos are now linked to the website, by the way. For live one-on-one tutoring and chat sessions, here's the website. The book Cost Accounting for Dummies is being taught Saturdays at 11 a.m. Central. We teach a chapter each Saturday. And the Twitter account. Thanks very much, and we'll see you next time.